the time when you hear me talk about this gap, this candle was forming, okay? And you would take that candle's low, assuming when the next candle opens, it didn't make a lower low on that wick. So that candle here, we opened up here. So there's time. There's time to drop a limit order in right below that low. One of the things you can do is you can set up limit orders and have them 100 some handles or so away, that all you have to do is just drag them to a location when you're expecting a silver bullet to form, because that's what that was right there, by the way. It's a 10 o'clock fair value gap that is easy to understand because now you've seen what happened. There's been a disruption. There's been a shark frenzy. There's been this evisceration of orders below that low and that low. We dove down below it. Then the market gets back above. We want to see it touch the new day opening gap high, minimum, or consequent encroachment, or the low, but we don't want to see it go below the consequent encroachment of that wick on a closing basis. Ideally, we don't want to see it trade to it at all. And it didn't do that, right? But your entry model is going to be based on this. So that way it completely strips away all of the necessity and the fear of where do I buy it inside the fair value gap. You buy it at the high of the gap plus one tick. That assures you that you're going to get filled. And it's also doing what? It's allowing you to sit in a little bit of drawdown, and it's normal. It's normal. Whenever we're looking for a PD array, if they are not traded to, or if they, for instance, like a gap, if they don't completely overlap it, like we were outlining here, I was saying at the time, let me make this a little bit larger. When this was forming that candle, this candle had not closed yet. It has not closed. The next candle, I want to see it drop down right below that candle's wick, which it does here. You may or may not have been filled there, Caleb, to be fair, because it's literally like one tick or two. So to prevent that from happening with your entries, you're going to use that candlestick's low plus one tick above it. So that means if it books two ticks below that low, you should be filled. So the fair value gap, we don't need it to come all the way down to the low end, because that's what folks that are prematurely trying to teach my concepts, they're saying that you can get filled at the low end and you'll have the best, and your stop loss will be micro, short, and small. You don't need that, because if you haven't picked up on what I've been laying down here, knowing where the market's going to gravitate and draw to, okay, where the market's going to draw and gravitate to is more important. Which has more impact on trading, not just your trading, but everyone's trading? Your ability to get in on this fair value gap that maybe not 75% of the people that trade even are paying attention to, or where the market's going to draw to because their stop's resting right up here. Clearly, it's where the market's going to go to. So if we have done the work and we're laying the groundwork and foundation for that to determine where the market's going to go over the course of the session, over the course of the day, which we haven't got to that part yet. So far, we're only working with session draws on liquidity, and they're dynamic. Session draws on liquidity are dynamic. That means it's above and below. You have to start there. You will not know how to derive the daily bias until you get good at knowing how to determine what side of the session bias is going to be the draw. Didn't think about that, have you? But that's how I teach. That's how you learn it. But if you can formulate an entry mechanism that affords you, number one, a high precision entry model, which is obviously institutional order flow entry drill, you don't want to see that gap filled in. But what happens if you get filled and it does close it in, Caleb? Nothing. It just means you have a little bit more drawdown. It's not that much from this candle's high to the low of that one. Same thing you're seeing right here. You're watching and observing. You're waiting for the still waters to be disturbed. Watch the water turn red. And then look, where is it smooth? I gave you both sides of the marketplace. That means you're looking at both ends of the session, because session draw on liquidity, session liquidity is above and below. All you have to do is wait for them to do the damage, wait for them to do what's the time window. You're going to see it at 10 o'clock. That means you have to wait that first 30 minutes. Why? Because that is the opening range. That's that vertical line right here. So when you're watching price action, you're looking all through that first 30 minutes. Your eye is going to, where is the initial legs of liquidity? We gave them to you. Here is the buy side, and the sell side was over here. Here and here. And how far could it reach down, Michael? Remember I was telling you that? It can trade down into that new day opening gap. It can trade down into that. And if it's going to trade through that, we have that lower here, which was in view when I was showing you all this stuff anyway. Then, once it does that, it rallies back up to opening range gap, closes it in, drops one more time, overlaps into all this, the rejection block. You heard me talk about that as it's happening. Come back down, hits the new day opening gap from the 16th, rallies back up in. Look how the bodies are staying here. Remember I was saying, listen to this part, okay? It's spending too much time. It's spending too much time inside of the opening range gap. Meaning what? They're not in a hurry to pierce this high, much more meaningful than they did here. So this high and this high is still relatively clean. That's just tiny, it's little bit of movement. When the algorithm is trading just outside of the lines, it's okay. It's doing everything it's designed to do. To get that price high booked, it's got to go above it because there's a spread. Well, that's all it did there. Did it close above it? No. Did it have much more meaningful movement beyond that? No. Did it trade to the high of the new week opening gap for August 18th, this week's new week opening gap? No. So what is it leaving? It's leaving this liquidity and making these individuals over here feel safe. So what is it going to inspire if it sells off? Shorts to do what? Place their stop loss above here, or if they have deeper pockets, build it right there. So this is engineering liquidity. It drops here. I said, take your attention over here to these wicks, here and here. We watched it drop down below it, took out that low. And now I said, now watch. What I want to see is, does it get back above the new day opening gap on the 16th? And then does it come back down and touch that there? Yes. I don't want to see it trade down and below that wick's consequent encroachment. It never did it. But the questions are, how can they use this methodology and understand how to use the range that was formed in London? If you go back and listen to what I was talking about, if you're brand new, you don't know what you're doing, you don't worry about this. You don't worry about this. You wait for 7 o'clock and you look for relative equal highs and relative equal lows. Well, guess what? That's this, folks. That's the relative equal highs after 7 o'clock. Right here. Here's 7 o'clock. Okay. It rallies. We're waiting. 9:30 opening bell. All the way to 7 o'clock. You're going to look back through that. So if you're going to not be an early trader, you're not trying to trade early, you're going to start looking at the market at 9 o'clock, go back to 7 o'clock. So you're looking back through the last 2 hours. You only have to look back through the last 2 hours to see where the liquidity is. So here at 9 o'clock, right there, what do you have? High that's lower than that. Isn't that a relative equal high? Yes. What are these? Relative equal lows. So what is it doing first? It runs above these highs there, and then creates what? Another smooth relative equal high. But then what does it then do after that? It breaks lower, takes out the liquidity here, and we're watching the opening range. What's it doing? It's finding responsiveness at the midpoint. It has no ability to get to the upper half of it. So what's it going to do? Go back further to 7 o'clock. You only wait for the 7 o'clock and anything that forms to the right of that. But anything prior to 7 o'clock, well, what does that take you back to here? There. Which is what I referred you to when we were, what? Entering into that 9:30 opening. Where's the liquidity at? Here and here. And what did the market do? It addressed what side first? Here. After 9:30. That's here. Right there. So did it go for that liquidity or the sell side over here? Which side did it go for? It went for the sell side first. Came back up. Did it take that liquidity out yet when it was here? No. Did it take it out right here? No. So where'd it go? It went below one more time here. We were looking for it to sweep down to here. Then as it was dropping down, I said, watch these wicks in here. It overshot the entire low. That's fine. We're not in a trade. We're not getting stopped out. We're not getting squeezed out. We're observing and watching. What are we waiting for? We want to see it take that low out. Drops. What is this forming? Relative equal lows for anybody that's trading to 9 o'clock. Going in, waiting for what? The first 30 minutes opening range. High, high. Relative equal highs. In an area I told you this is going to be problematic. We need to study this. It's going to need to get through this little area here because there's two indecisive candles. Even though that this candlestick's closed and this candlestick's open, is basically symmetrical. It's close. It doesn't really provide a gap. When I see candles like this in the middle, two of them like that, that to me is something that needs to be repriced to. And if it goes through it in the direction I'm looking for it to move, then I'm fine with it. Then I'm going to disregard it and never worry about it again. But go back and listen to it while we were trading here. I said it needs to go through here. And it couldn't do it. Went lower, lower, rallied one more time. The body's staying inside the opening range gap. Just bumped that high and then took us down to clear this. I told you once it done this, I want to see it trade above the new day opening gap on the 16th. Come back down, touch that, and it did. And then I gave you, because of all the things I just outlined, which side did it work predominantly? The sell side. What is the side of the marketplace usually offered to the public first? The wrong side. Well, in the market, they send the traders on the wrong side. That's the Judas swing. That's the run on price action that gets people thinking, this is where it's going. I want to get on board, and they chase it. And if they're initially positioned to profit while it's forming, it gives them a sense of like comfort when you shouldn't be comfortable. It's usually the wrong side of the marketplace. And then it comes down, takes the low out. And remember I was asking, do you feel safe if your stop was here? That's me priming you. I'm priming you as a student. Okay, he's taking my attention up here. And I said, now what about the people that had their stop loss here? Who's made money right now? Shorts. Anyone long from that low is now unseated. Why did they do that? Because they're going to go here. So to run from here to here is profitable. To run from here to here is profitable. And why it went down there is to unseat the stops that were resting right below that low. I took your attention to this area here. Told you the fair value gap was going to be there before that candle closed. One tick below this candle, that's the institutional order flow entry drill, and we don't want to see that entire gap closed in. That gap looks like this. That's your fair value gap. It went down to this low. Is that still unfilled? Of course it is. That's exactly what you want to see as a signature. That is the algorithm tipping its hand to me because I know what the fuck I'm looking for. When it does that, it's going to be what I want to see. We want to see it rally up. Where is it going to rally to, Michael? New week opening gap low. And then we want to see it trade into the midpoint of that consequent encroachment. And does it touch the top of it? Look at the bodies respecting it again. Yeah, we wicked through it. And admittedly, when I said 6, yeah, boom, it happened. I thought because it flashed real quick, my eye was watching that. This line, I thought that was this over here. And it had to dig down. And I told you, okay, I want to see it go down into this area here. And there's a balanced price range in there. So it can do that and then send it higher. These things that will repeat over and over again in price action. The logic of waiting for the sell side and the buy side, once you define what they are, just wait for the first one to get taken. When that water is disturbed and you see violence, jagged, 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 the whole time, these are smooth and this is smooth. Oh, I want to be able to buy down here. Well, when it goes below that, you buy it then. Learn from that. Sometimes it'll be great. Sometimes it won't be. We want to see it trade above the new day opening gap. That means I'm saying that once it gets above that and it starts to trade here, as long as we don't breach that midpoint of that wick right there. Why? Because we've had the stops run below that low in here. So this movement is what? It's a wick on a higher time frame. It just doesn't look like one. It's wicking here to take us below that low and that low. So this low is the low that forms what? These relative equal lows. And it's also being respective of the new day opening gap. See the bodies? Is this one doing it? No. See, that's logic. That's logic. I'm not going to refer to this one as we go back above it as support. I'm going to use this one because this one here is already showing that it's done what? It's respected it. So the algorithm is going to go back to that one. It's not going to refer to this one. Which one was on the new day opening gap? And the bodies are showing it right there. So now my attention was focused there. We went above it. I'm going to see it trade down, touch the opening. I'm sorry, the new day opening gap high, and it can trade as low as that low one, but we don't want to see it close below that wick of that candlestick's midpoint or consequent encroachment of it. And it only gave us a touch of the high of the new day opening gap, rallied, showed displacement. Wonderful. Next candle as it's forming, this is going to be a fair value gap. Called before it formed. Institutional order flow, called before it delivered. I was off by 2 handles, 8 ticks, or thereabouts, or 7 ticks. Would it be 7 ticks? We'll just call it 2 handles. It did not close in that gap, which is exactly what I told you. That's ideal. And then it's off to the races. Look how it responded off of the consequent encroachment of the opening range gap there. Isn't that beautiful? If price was personified as a rock climber, okay? If it's a rock climber, you can look back over here and see what it's going to place its hand in, and or what it's going to place its foot in. I told you it's going to go down into this gap, this fair value gap in here, pull down into this balanced price range. Trades into it there. Only by the wick. Consequent encouragement sends us. Boom. Heartache. Shorts are unprofitable. Longs that bought in here, knocked out. Who made money? They cleared the table, both sides. It's elements of time, then waiting for price to do something as a response to what's done at a specific time. You're waiting. And to make it very, very easy, to make it very simple, I taught to outline the liquidity above and below the marketplace and wait for the first one to be taken. And then the second one will come later, because the first one shall later be last. That's in scripture. That's the same thing you're seeing in the marketplace. This liquidity was saved. And what you're going to learn, the key takeaways, Caleb, is if this is going to be taken second, that means it's going to potentially move a little bit more beyond this one. Meaning what? If you know that a daily range, I said, think of this as a individual bar for a daily chart. Okay. So in other words, it's representing the highest high and the lowest low of the day. Okay. And say in your mind that you're looking at the market and you're studying weekly charts and monthly charts and daily charts over the weekend before the market starts trading on Sunday at 6 p.m. But if this is the daily range, okay, not a candlestick, but an open, high, low, close bar. So this is the open, this is the lowest it made for the day, and this is the highest it made for the day, and this is where it stops trading, okay? If your thinking is that we're probably going to move up over a series of days, or for the week, or for the month, or we're moving in that direction higher, okay? And you're watching price action at 9:30 here. And you've defined, as we did here, the sell side was here. We incorporated that old new day opening gap, and we gave you the buy side. So if we're opening right here at that candlestick's tick opening, if that opening price, so that opening, we opened, went up, closed down. That opening right there represents this graphically in my diagram, okay? And then from that opening price, that movement from here to that low would represent that low on the daily open, high, low, close bar. So what we're saying is the open and the initial drop down, that's the fake move. That's the Judas swing. That's where smart money buys, okay? Now, the complication comes in at where you are going to be a buyer. I don't expect my son to be a buyer down here. I don't expect him to buy the rejection block. I don't expect him to buy down here below that low. That's too much of an expectation placed on him. He's not. It's going to take him a long time to try to buy below here. But that opening price here down to that low in that area, that range, that means where this low forms and where the opening is, you're hunting. You don't have to have the low tick. You're just hunting something to be long. But this opening price down to that low, that range, okay, graphically looks like this. That little sweet spot right here, inside that range, that's where your best opportunity to buy and hold, and just wait until we get to the lunch hour and then measure out where it can retrace. So if there's going to be a lunch macro, if it's going to go lower, you can determine where it's going to go lower. You can determine that and not place your stop loss within grasp of that. Ideally, what you want to do is learn to try to enter when you're bullish longer term, when you think it's going to go higher. So don't think that this is a one-trick pony, intraday trading only, and you can never use it to make bigger money. You can, but you can't appreciate this type of daily candlestick close until you first learn how to read these intraday price fluctuations. Because by doing it this way, number one, you're going to get a lot of exercise. You're going to get a lot of price action to digest and learn from. Because everything I'm showing you here is fractal. But for those individuals that know that this is what it looks like, not every classic buy day or classic sell day, where it's just one direction, that's not the same. A classic buy day is just, it moves up and closes up high. It doesn't mean it's one direction with no retracements. There's sometimes it's like that, and if you're able to hold on to it, they're very, very fun. And I'm teaching you how to do those types of things right here, right now. So if we know the opening price, that's a finite number. They're not going to move that around. It's right there. It's the opening tick on that candle. Then simply wait for it to drop. Aim for liquidity or aim for any inefficiency below that price to the left over here. Okay, the first stage is where the sell side liquidity and then that new day opening gap. It pierced through both of them. And then what did it do? It came right back to opening range. And then I said I was spending too much time into it here. And then it drops. Takes out that low. Then I took your attention to that wick, the midpoint of that, and we want to see it get above it. Treat the old new day opening gap. Taking your attention right there, it's going to form a fair value gap. And it's going to be an entry that's an institutional order flow. Entry drill. That means it's not going to close the gap in. It's going to leave a portion open, and then it fucking does it. What's occurring? This fair value gap with the institutional order flow entry drill and leaving that gap open, where's that forming in the context of the daily range based on this logic over here? It's inside that open to the low. Open to the low. Look, I'll use the same thing. Graphically depicting, I'm not predicting the closing price, don't get me wrong. I'm just saying if you go in every single day with this logic while you're learning how to do it better, this is how you grow in holding on to trades, and eventually you are going to catch a fucking tiger by the tail. Knowing what you're looking for, waiting for the criteria to be met, and then having sound logic saying it should behave like this, and then it does. Inside the range between the open down to the low, there's your fair value gap right there. That is your low risk buy. So eventually what happens is by entering like this, when you have a longer term bias that you derive from a monthly and a weekly chart. So if you're bullish longer term, and you think that this is the criteria that the daily candles are going to form, or the day that you're trading is going to form this. So this is basically like 5 o'clock or 4:15 Eastern Standard Time, that closing price. In relationship to where you opened up at 9:30 down here, that's bullish, isn't it? So how can you hold on to those trades without having a whole lot of fear, anxiety, or I'm scared I'm going to get stopped out? You have to determine how to buy at the open or below it, because rarely will it go back down after it runs up here. It rarely goes back down here. If it does, it's probably not going to create this condition here. So why do I teach you to take partials? Because you don't know when it's going to turn on you. You don't have the advanced understanding. You don't have the experience. You don't have the time invested in knowing how to navigate price. So by entering in after what side of the marketplace and its liquidity. Remember, we framed it here. This is easy, folks. I don't know what the fuck you people are complaining about. Relative equal highs and the relative equal lows I gave you this morning. Which one does it hit first after 9:30? Bang. Okay, so what does that tell you? That's the first stage of catching a power three day like this. If you're going to try to hold for a long, big up close day, it has to drop down and take the sell side first. It did it this morning. But if you take the sell side first, that's the first qualifier for an up close day. Because what is it doing? It's tricking people that it's going to go down. That's the Judas swing. When we're bullish, well, what makes us bullish? Well, what we just watched today. It took the sell side first, and then it reaches for the buy side. After seeing that for days, weeks, and months, you get comfortable with that idea. You don't need somebody else to tell you in another video. You don't need ICT to answer your question about the bias because you've already seen it. So then the next graduated step is holding through lunch. Aim for 130. Close your trade entirely at 130. If you're in profit, close it. And you keep doing that. And then eventually what you'll do is you'll watch and see that eventually you'll start seeing the days that do these types of things, they close near their high, but just off the high, like it does here. And you'll see that during the last hour, it creates that far extreme high. And then right before close, it comes off that. And that closes just a little bit below where the highest high was for the day. So if you do your work of buying below the open, at or below it, and I gave you that real time here today, in such a beautiful, beautiful tapestry.